This is our first episode of the Business of Finance podcast show. That's the name I've decided on at this point. It may change, who knows? But this is the first episode, and we've been graced with Noah's presence because he is a wealth of knowledge, as always, in so many areas, and he's willing to discuss today with us, kind of to create a baseline for the podcast and history and theory and why and how they work, and again, some of the history of that. So welcome to the show again, Noah. Thank you.
Thanks for having me here, Greg. This promises to be a lot of fun.
Yeah, absolutely. Well, it always is with you, I have to say. So where should we start, my friend? This is your area of expertise. I'm here to learn from you.
Well, I think the sort of easiest place to start is probably Adam Smith, who was kind of the godfather of explaining what was going on. He didn't invent markets, but his book on the Wealth of Nations more or less invented economics, as we generally commonly deal with it. And he created what is still one of the most powerful explanations of markets to this day. And so Smith basically decided that what made economies flourish was specialization. The Wealth of Nations came out at, I believe it was 1776. It's in any case roughly the same time as the American Revolution. It was the early days of the Industrial Revolution, and so economies were starting to transition from sort of purely feudal agrarian to a lot more urban, factory, other sorts of tasks being a part of the economy.
Can I jump in for a sec?
Sure.
A question, and I might do that a lot just because, clarity for myself and listeners. So specialization, what do you mean by that exactly? Like subsectors and that sort of thing? Or
he has an example very early in his book about a pin factory. And so blacksmiths could make pins, and I'm not going to get the exact numbers right, but he figures that a blacksmith using sort of medieval techniques working for a day could make, say, a dozen pins. Whereas a factory with like 20 people working in it, each one of them working a specialized job with a machine and probably some sort of water wheel to help the machine go, could do like 500,000 pins in a day. So you take like 500,000 and you divide by 20 for the number of people, and then you divide by like 10 for the number of pins that the blacksmith could make, and you get a 2,500-fold increase in pin productivity. And so that's his big, like, look at this, by taking a job and turning it into a bunch of jobs and then building machines to help those people do those jobs and organizing them correctly, suddenly we're thousands of times wealthier in pins than we used to be. And that this was something that you could see happening across the economy in other areas, that it wasn't sort of just farm to table. There was millers and bakers and transport and all kinds of other things all going on for food supply. Cloth was a really big deal in those days, and that was being mechanized and really changing the scope of what was possible. So the trick with this specialization was organization. How do you know how much to do if all you know how to do is run the 17 pinhead machine? Like, should you be doing more of that? Should you be doing less of that? Like, what's going on? And so he came up with this concept of the invisible hand of the marketplace, this notion that voluntary interaction through the price mechanism would allow supply and demand to express itself through floating prices. So it wasn't terribly uncommon in old or ancient days, or even in relatively modern political history, for the local powerful person to say, hey, you know what? Bread should cost a nickel or $50 or whatever, because that's what it cost when I was a kid, and it was better in those days. And Smith says, no, that's stupid. Like, we don't know what prices should be. Price is a signal. Mm-hmm. And what it's doing is it's allowing people who aren't tightly connected to one another, who have differential specialties, to express their needs and capacities to one another in a language that's simple enough and universal enough that the entire system can sort of find its way forward to a general maximum. And since his work, one of the really big efforts of economics over the last 2.5 centuries now has been demonstrating mathematically that this all actually works out, that kind of idea is a reasonable optimization control program, and that having agents interact through a price mechanism of marginal interest really does find the condition under which the system is operating at its highest potential.
Okay. So did this Adam Smith, did he coin a name for this this philosophy, a financial philosophy, or?
So generally, laissez-faire economics is associated with Adam Smith. Okay. And so that laissez-faire, from the French, sort of hands-off, is the notion that governments shouldn't get in and get involved, because the price discovery mechanism is doing what you would want to do. It's making you wealthier. There's been a lot of work also on what happens with interventions and other sorts of caveats, if you will, to this.
Yeah, certainly. I don't want it to turn into a sociological experiment or podcast or anything, but socialism, certainly, how can that relate, or what's your view on that, just from the data? Like, does socialism work when it comes to what Adam Smith is saying?
Well, on the data, it's abundantly clear. Socialism doesn't work anywhere under any circumstances where it's tried. The good news for the socialists is that an enormous amount of wealth actually has been created over the last few centuries. And so there are aspects of that sort of allow socialistic ideas to be introduced to a society without immediately killing everybody. On the other hand, in the 20th century, there are numerous examples of socialistic ideas being introduced to society by sort of immediately killing everybody. So there's a lot of bad and some sort of tolerably okay there. Mm-hmm. There's certainly an open question of whether economic maximization is actually what would make people happy. But when you get into sort of that aspect of things, responsible economists generally talk about trade-offs, and again, I also don't really want to go off into a sociological tangent, but it isn't abundantly clear that we know what all the good things or all the bad things to avoid even are. And it's absolutely clear that we don't have the physical or moral capacity to either exclude all bad things from happening or to cause all good things to happen. Right. And so a lot of political rhetoric is based off of essentially unfair nonsense, where guy A stands up and says, oh, look, bad thing happening, make me powerful, bad thing shouldn't happen, ignoring the fact that lots and lots of bad things happen and lots of good things don't happen, and him becoming powerful may not even abate bad thing that he's pointing to become powerful. And it's not like guy B who stands up and says, oh, good thing could happen, make me powerful, good thing happen, is going to cause, the good thing he's pointing at to occur or not bring more evil into the world or whatever. Yeah. So that's very difficult. Where the economics profession has dropped the ball on these issues is that, particularly in the modern era, say for the last century or so, economics has very carefully removed its normative stance. So it's like they're not telling you what good or bad is, they're telling you what the consequences of actions are. But what has occurred as a result of that philosophical shift is that in common discourse and actual political action, people largely have come to accept that if the consequences are economically beneficial, therefore it is good, which hasn't quite gotten to the point of, well, the criminal made money, so it's okay, but it's gotten really, really close to that in a number of fields, and that's causing issues.
Yeah, absolutely. It's almost as if it's okay until they get caught and everybody turns their back on them.
Right. Yes. Right. And that's kind of what we saw in sort of the global financial crisis situation. None of what any of those people were doing was ethically reasonable, and most of it seems as if it were legally questionable, but certainly not until after the crash. Well, and then once the crash happened, they were like, well, we got an emergency, we got to bail, we can't look into any of these crimes because we've got more important things to do.
Yeah, definitely. Well, and somebody had to take a fall, right? I mean, that's just the system we're in. They bailed out a bunch, but not everybody, right? So going back to Adam Smith's philosophy, how does that connect to capitalism today? Was there a transition that happened, or is it, the same system?
Well, so the thing that's interesting is that Adam Smith wasn't proposing this. He was describing the situation on the ground, as it were. Okay. The markets that he was dealing with were already ancient by the time he was writing, and are more or less the same as what we have today. And they go back to the Renaissance. We do not attribute them to an inventor. The general story is that markets evolved more or less by accident through the combination of coffee houses, chalkboards, and late medieval Northern Italian culture. So the basic story is that after the fall of the Western Roman Empire, the Mediterranean was effectively a loose affiliation of city-states, sort of preeminently led by Constantinople and the Eastern Roman Empire, which controlled the choke point, the Bosporus between the Black Sea and the Mediterranean, was still, by all accounts, the Roman Empire, extremely powerful, extremely wealthy, and everybody else was essentially living in the Dark Ages. With the advent and popularization of coffee, the Northern Italian city-states of Venice, Genoa, Naples, those sorts of places, sort of created this plaza-based trading structure where the cloth or spice merchants would all go down to one coffee house and spend all day drinking caffeine and talking to each other about their deals and how things were going. And that was then combined with a chalkboard to note up the deals that had actually been made. So a public record of the history of deals which were made, combined with a semi-public negotiation of the deals. Okay. And that combination of knowing where sentiment is, because you get to see what deals have actually happened, combined with being able to negotiate with essentially everybody who could be of interest to negotiate with simultaneously, creates a very powerful mechanism for the group to come to a common consensus that's of common interest. So what happened was the economic center of gravity of the Mediterranean shifted from sort of the northeastern end there in Constantinople to these cities, these city-states in northern Italy. And they got very, very, very rich. And so they decided to start spending a lot of money on artists and historians and scientists and engineers, and that was the Renaissance.
Yeah, very interesting. So I'm thinking, how can we make it relatable on, like, because we're talking about basics, right? And we all know by instinct and programming that, if something's in scarcity, the value goes up, right? But why is that happen? And how does that affect the markets? I mean, you've got X amount of oil that's available to the marketplace. However, our prices are fluctuating and ridiculously high. Why is that? And maybe that's not a good example to start from, but can you help me and the listeners understand supply and demand?
Sure. Well, let's think in sort of terms of those Northern Italian, highly caffeinated busybodies. So let's say they were trading oil, and there's a local oil shortage. People have been reading late at night a lot, and the tanks are getting pretty low. So lots of people go down to the oil coffee shop and say, "Hey, brother, can you spare some lamp oil or whatever it is we're looking for?" Well, there's lots of people saying, "I want to buy, I want to buy, I want to buy." And so when you walk in there, you get to see that, Usually it's like 50-50, but right now it's 60-40 or 70-30. So you go in and say, hey, my ship just came in. I've got some oil to sell, and you get mobbed. Well, what do?
Yeah.
You want to make money. So the first guy comes up to you and says, yeah, I'll buy your ship full of oil for whatever the going rate is. Let's say $50 a barrel.
Mm-hmm.
And then the guy who's standing right next to him, who also wants to buy oil, says, screw him, I'll give you $52 a barrel. And the guy who's, clawing his way over that guy's back says, my kid's about to die because he's cold. I'll give you $70 a barrel.
Yeah.
And you just kind of take it in until you hear whatever the best deal is. And you say, okay, you want to give me $70 a barrel? Done. Write the contract up. And then what happens is that goes up on the board, and everybody sees that oil isn't selling for $50 a barrel anymore, it's selling for 70.
Yeah.
And so when the next guy walks in, not only is he confronted by a mob, he's confronted by a mob that has a sign up on the door that says 50 isn't where we start, screaming at each other, 70 is where we start screaming at each other. And that happens until things are back to 50-50 and we're in an equilibrium again.
Okay.
And maybe the price goes up to 100 or 300, maybe it goes up to 55 or 60, but whatever it takes to get interest and offers into balance is where things head.
Yeah. Okay. All right. Thank you for that. That's a great analogy. And simple, really simple. I like that. And then, so I'm going to jump all over the place because things just come to me, right? So now we're talking about interest rate level. That's where I want to go, interest rates. And how are interest rates determined?
Well, again, that gets into a bit of a tale, particularly if we're talking about the modern world. So let's start with what interest rates even are, just to make sure we're on the same page.
Good.
Interest rates are the price of money itself. So if I don't want oil or cloth or pepper, but I want cash right now, I can get cash right now under certain circumstances if I'm willing to pay for it. And since I can't pay cash right now because that's what I actually need, I have to pay future cash for cash right now.
Mm-hmm.
And so the interest rate is how much future cash people are willing to accept in exchange for cash right now. And this gets complicated because there's a lot of things about collateral and credit worthiness that are balled up into this. The people who are giving away cash right now are generally relatively reluctant to take any risks at all. They're basically looking for free income for being rich, which humanity is willing to provide to them because humans might actually need cash right now for any of a wide variety of reasons.
Mm-hmm.
So those people want to know that the people that they're giving the money to are going to pay them back one way or another. And that's where things like collateral, where you have something that you could sell, maybe, but maybe not as quickly as you would like to, or as effectively as could be done. So, for example, when you finance a house or a car, using the house or the car as collateral,
Mm-hmm.
and also credit worthiness. If you're a pillar of the local community and a father of 7 and you've been around for a long time and you just need $20 for something, then that's not a big deal. if you walked into town yesterday and you're, wearing a few scraps of clothing and nobody's ever heard of you before, and there's a leg iron manacled onto you, and you need $40 million, no questions asked, maybe that's not
That might not be a good idea.
right.
Yeah, man. Something came to mind before you go any further. If anybody's listening and they're doing sales and marketing, that's the greatest analogy right there. You don't just walk into a room and start selling. You got to build your credit worthiness, your value, all that stuff. Anyway, sorry to interrupt you. No,
Absolutely. And so all of those things are factors in interest rates. There are people who might be willing to loan money to the clearly escaped convict.
Yeah,
but they're going to be looking for a lot more back than the family man that lost a bar bet or something.
Yeah.
Those things all go into interest rates. When the news talks about interest rates, what they're usually talking about is these sort of baseline interest rates. In modern economies, with our fiat currencies, we have this kind of stack of credit that is the basis of monetary flow. And at the base of that stack, like today, is the Federal Reserve note of the United States, although that is related to some historical accidents since World War II, which have been under review since the Nixon era, when we closed the gold window.
73, I believe.
Yeah,
maybe
it's either that or 71.
That might have been 70.
73 is a highly significant year in economic history because lots and lots of things all happened at the same time, then sort of sociologically, not least of which I think was the beginning of stagflation.
So let's have you, okay. In so many directions to go here.
Yeah. But yeah, kind of sticking to the pure economics, the interest rate that is offered on treasury bills in one sense is absolutely controlled, and in another sense is subject to market activity. Okay. But we've never seen the market discipline actually happen yet.
Right.
So the United States Federal Reserve essentially decides what rate will be placed on issued T-bills, and they can do that. The T-bill is basically a note that says, I will pay 100 and X dollars on such and such a date that sells for $100. And so by deciding what X is, they decide what the interest rate is.
Right. And that's a bond, correct?
That's a bond, yes. And a bond is it's just a loan. That's all it is. That's where the, with the CDOs, the collateralized debt obligations, they were taking loans and turning them into bonds effectively. Which is not that big a step because loans are bonds and bonds are loans. Yeah. Now, while the Federal Reserve is sort of free to write any number in for X that they feel like, there's a market discipline aspect of this because those bonds are then sold to the marketplace to be purchased. And so in theory, they could not be purchased. And the marketplace could reject that. And there are a handful of instances when not all of the bonds were instantly snapped up, but only a small handful of instances. And that's it. Like in general, over the last, since World War II, when the US government says, hey, we want to borrow money, the world says, shut up and give me your paper. So far, we have not seen extensive subjection of market discipline. Now, one of the reasons we haven't seen that is that the Fed mostly follows where the marketplace is going. And these guys aren't, for the most part, just behaving in an arbitrary dictatorial fashion. So they could write like 100 on there and jack interest rates up to 100%. And they could do that, tomorrow if they wanted. Like the chairman of the Fed could just call people up and say, okay, emergency meeting, get in here, pull out the gun and say, we're doing this, and issue one of those. Now, he's never going to do that. Like, that's just never going to happen.
No.
Yeah.
Where do the Rothschilds and the reptiles come in? I'm just
the Rothschilds enter our picture pretty much around the same time Adam Smith does, actually.
Is that right? Okay. Yeah.
Yes.
And was Morgan Stanley was in there too.
So the Rothschilds were a banking clan in Northern Europe. And so we'd gotten marketplaces sort of cleared off to Northern Italy. But of course, they are not the center of economic life on planet Earth these days. So what happened? What happened was the discovery of the New World. And so the Spanish started going over to Mexico, Colombia, that part of the world, and digging out what were effectively virgin silver mines and filling up boats that were 3 to 5 times larger than the boats people used to drag wool and pepper around in, to the gunwales with silver and gold and dragging it back to Europe. And it was so much that when Francis Drake outfitted the Hind and went and just stole one of these things, that enterprise had something like a 5 million% rate of return.
Oh my God.
So yeah, that's the whole age of piracy and exploration and empire, and like that's why all of that happened.
Yeah. In that vein, this is a bit off topic, but not. When did the whole transition go from empires, like you had the Ottoman Empire, which was kind of the last of the empires, transition to corporations? Like, when did that transition happen?
World War I.
World War I?
Yes. Yeah. Basically, World War I was the last hurrah of the feudal system. Victoria was, England had pretty much gone to constitutional monarchy. Victoria was never overturned anything from her government. That was, I can't remember her name, but it was back in the 1790s was the last time an English monarch had overturned anything from the government. But Victoria was significantly more powerful than Elizabeth was, for example.
Okay.
Elizabeth II. Elizabeth I was like an actual monarch. But Germany, Kaiser Wilhelm, who was I think nephew or grandson of Queen Victoria, he was the aristocrat in charge. The Austro-Hungarian Empire was an empire that had descended out of the Habsburgs, and they were in charge of modern day Yugoslavia, Czechoslovakia, Austria, and so on. The Ottomans were a for real, Muslim theocratic state that had been running the place for centuries at that point. And of course, Russia was under the czars, who were for real absolute monarchs that were operating under the, God says so regime, more or less. And the result of World War I was that 100% of those governments were utterly destroyed.
Wow. So does socialism always turn into communism?
Not yet. There are some socialist systems that haven't gone full communist yet.
Yeah.
Socialism is fairly young. Socialism is largely a 19th century political phenomenon that was somewhat a reaction to urbanization. There are people who point to the ills of modern cities, and quite rightly so. The vast expansion of homelessness and public drug use in the last, say, few decades is bad, and it should be criticized, and it should actually be fixed up. I mean, cities were not like this, say, 50 years ago.
Oh my God.
But 150 years ago, cities were much, much, much worse than that.
Oh, absolutely. Yeah. Dumping sewage out the windows and
well, not just that. Widespread alcohol abuse, prostitution, leading to mass orphanage or abandoned children, and an entire, sort of industry of criminality and exploitation of unattached minors. Things like Oliver Twist, which are sort of comic horrible in modern sensibility, were putting a very bright face on a very dark reality of gathering up children to turn them into pickpockets or chimney sweeps or bobbin boys, which could and did kill them in large numbers.
wow.
And societies were in many cases horrified by this, and we don't really remember the names of some of these reformers anymore, which is a shame. The people who sort of fixed things up and went away, we don't remember them. The people who were like, oh, bad thing, we should become powerful, in many cases became powerful, and bad thing, sort of kept happening. There's a utopianism at the core of socialism, and the worst part at the core of Marxism is the notion of objective value, and that's actually not. That's where Hume's thing about not being able to extract an ought from an is. What the markets, as we were describing, sort of how oil prices would get renegotiated. Markets are attempting to discover and disseminate whatever the reality on the ground is. Whereas socialism essentially asserts that it's possible from first principles or with a lot of thought to figure out what the prices ought to be, assign those prices, and then have sort of the world fall out as a result of having done so. And that's just false. It is not possible to a priori figure out how the universe exists and then do the right thing. You've just got to kind of find out what's going on and then do the best thing you can do. And as a society, hopefully we would reward those, doing good and punish those doing badly in an attempt to get more of the former and fewer of the latter. But you don't, there's no practical way, and there's no theoretical way, and there's no other way to just sort of sprinkle the magic fairy dust and say, I know what good is, because you don't.
No, because you...
And therefore I will cause all good things to happen by saying the right set of numbers.
Yeah, it's ridiculous.
Yes.
Yeah, I wonder if if we'll get hate mail, but that's okay. That's attention nonetheless. Yeah, dude, I don't have an answer to that. Nobody can make the right decisions. You just have to make a decision sometimes. But on pricing, it's a totally different thing. The market needs to determine that, just like it determines your value. What kind of value is a single person bringing to the market, right?
Well, we could get off into a jag on transaction costs there, because that was one of the challenges. So once economists had sort of gone all in on Adam Smith and how markets are fantastic, and then did all the math work to prove that that's true, they then had another problem, which is, why do these non-market things exist? Like, why kings were still a thing at that time? Why are kings if markets make good choices and humans make bad choices? And today, why are CEOs if markets make good choices and people make bad choices? Why do you decide what to have for breakfast, or decide where the family vacation is going to be, if we know as a human you're going to make bad choices and markets would make good choices? And so the answer is transaction costs, that there is time and effort and money and everything engaged in building and utilizing a marketplace. And so if the cost of an error in judgment is less than the cost of the assembly and usage of a marketplace, then making bad choices is rational rather than making good ones through a market. And so deciding, what channel you're going to watch next while you're vegging out on the couch is a personal decision. And maybe you could make a better one if everyone on earth was engaged in a channel market that was figuring out what the good channels actually were. But the cost of watching a worse show than you could be watching isn't significant enough to make it worthwhile enough for society to have a channel marketplace that would actually put the best next show on for you to watch.
Yeah, absolutely. That's good. So something occurred to me when you were talking about CEOs, and certainly, in the corporations today, there's a lot of, well, not so much CEO, but presidents, vice presidents, and it's just ridiculous, the management, the top heaviness of it all. And I'm curious what your thoughts are on Carl Icahn. Have you ever looked into Carl Icahn, what he does?
So yeah, he was a bond trader back in the 80s, wasn't he?
Well, yeah, and I mean, he's most known for shareholder activism, but he can look at a company and know where the value should be, and then he can say, look at all of these executives. I mean, it's ridiculous,
Yeah. Well, so I think what his sort of thing was he would look at companies and say, okay, you own a factory that if it was scrapped, it would be worth $40 million, and your share price for your entire company is $20 million. So how, like, what are you screwing up?
Exactly. Yeah.
That's worth negative $20 million. And how could I fix it?
Well,
And so
exactly.
then he would get a bond issue together. You know, I will gladly pay you Thursday for a hamburger today. Get the cash, go in, buy the company, and then either find whoever the negative $20 million idiots were and kick them out and turn them into a functioning company and pay off the bond, or just say, you know, oh, the problem is you guys are manufacturing buggy whips and we have cars now, so nobody cares. So I'm going to fire all of you and I'm going to scrap the stuff, and I'll pay off my lenders that way.
Yeah. Yeah, absolutely. And he's looked at it in two different lights. Like he can be looked at as an activist or a raider. I choose to look at him as an activist, but yeah, no, he's a pretty remarkable guy.
Yeah. It's, for me, like, I don't know how you tell the difference.
Yeah, that's a hard.
And it's important for the difference to be told, but I'm pretty firmly, like, the math on sort of how markets function and why they work is all quite compelling. And so like, when there isn't a marketplace, I sort of don't have an opinion, because I know, like, I have visceral reactions to some of these things,
Right.
but I know I'm probably wrong most of the time. So,
well, I don't think that's true, but I want to go back to cash and barter, if you will.
Okay.
Yeah, so I mean, there's a lot of theories on this, and I've, not studied, but I've read a few books on it. And what is the relationship between cash and barter?
Essentially, cash simplifies barter.
Yes.
So in a more or less basic agrarian society, so you're living in a village, there's maybe a couple of specialists, maybe there's like a guy that makes barrels and does some other carpentry, and there's a guy that works iron and a few other knickknacks, and then everybody else farms, and then there's the local squire or baron who's in charge, and that's it.
Yeah.
Well, the baron gets paid by tax, and he better be enforcing the law. The cooper and the blacksmith, how do they get paid? Well, in kind, right? So if the blacksmith's going to spend all day at the forge and not all day on the fields, then his family's still going to need to eat. So you're going to have to kick in some chickens and bread or whatnot, so his family can eat too. So that would be a barter situation.
Mm-hmm.
If you have money, then a merchant can come in. So some guy pulls in a wagon, and he's got some, pepper from the east and silks and a bunch of other stuff that's really cool, that's great to have, that doesn't come from anywhere that you've ever seen or will ever see. What does he get paid? Well, a couple of chickens for the night aren't going to cover it.
No.
Like he's been working. He's going to be working.
Yeah.
He needs more than that.
Yeah.
And you can't give him like 500 chickens, because he's not going to stop and start a farm, and they're not going to keep. Yes. So you have to have something you can give him. Mm-hmm. And so you could, like, if your cooper's really good and your blacksmith's really good. Maybe you can make the best wagons and you could give him one of those, and that would certainly be worth a cask of pepper or some gunpowder or something.
Yeah.
On the other hand, if money exists, maybe you could give him a few chips of silver or gold.
Yeah.
And then he can go down to the next town, the next city, and so on, and keep trading things around that way. Mm-hmm. And so societies that have created standardized cash systems have been able to take advantage of the economic gains that can be gotten from lots and lots of people making transactions. So
yeah,
sort of going all the way back to the beginning
mm-hmm.
of Smith, if transactions are voluntary and sort of free of let or duress or anything, then each party has to see an advantage in what's happening. And under those circumstances, sort of the amount of goodness that exists increases. So if you and I are engaged in a private transaction,
yeah.
and I give you a 20 and you give me a cake, you wanted the 20 more than the cake and I wanted the cake more than the 20, yes. And we're both better off. Yeah. Now, the trick, and Smith actually addresses this, is that not all transactions are private. If I give you a 20 to fill up the gas tank on our getaway car so we can rob a bank, other people are being like, I value the full gas more than you, and like that. Yeah. But the people whose bank we're going to rob are being harmed by our mutual goodwill. Yeah. And so the system's coming down. So it's not some sort of pure case of trade just makes the world a better place, but trade is a good mechanism within the confines of things that are private transactions and don't have these sorts of ripple effect type things for individuals to make the world a better place.
Okay, good. Love it. Great explanation. So Keynesian economics. What is Keynesian economics?
So Keynesianism is basically a post-World War II thing. Keynes had been operating more or less since World War I and so on, but his ideas became dominant when he was sort of the principal architect of the post-war monetary system, which put the US dollar and therefore the US Treasury bill at the base of everything. And Keynes is just nonsense, I'm sorry to say. It's very popular.
Yes,
and much like socialism, it's an extremely effective form of political rhetoric. But Keynes's core arguments do not hold logical water. And some of the most ridiculous straw man sounding counter arguments for his thing are in fact just direct proposals of what he did. So Keynes essentially argues that the money supply is in the hands of the government, which is broadly true. Currencies are a political phenomenon. They are not some sort of natural handed down by God thing. They're not at core just the gold standard. Like, the currencies are a social, cultural, political like thing, and they need those things in order to function appropriately. And societies have existed with with worthless currencies for longer than any societies which presently exist have existed. So that there's a thing. The Spartans intentionally made their coins out of iron so that traveling merchants would never trade there in order to keep themselves Spartan.
Yeah. Wow.
So that's a thing. So what Keynes says is that unemployment and inflation are related to each other, and money supply in general is related to economic well-being. And so there's a sort of animal spirits, he called it, where the market would do all this cool market making things better stuff, but then the people in the market would just get like tired and, you know, full and not want to get rich anymore. And so they just kind of slack off. And that's why the Great Depression happened. Like, you know, people were happy to get rich, and then they were like, we're rich, we're just like gonna slack off. And oops, there isn't an economy and everybody's starving to death. I guess I still don't want to get rich. So, man, it'd be so easy to go out there and get wealthy, but we don't feel like it. And so under these particular circumstances, governments could step in, and because the amount of wealth that was, the amount of money that was there wasn't sort of a big enough number to get people off the couch, what the government could do is they could just inflate. They could just like create some more money, make it a bigger number. And then, you know, all those people who were starving to death because the economy was in shambles would be like, oh, but more money. Like I thought I was rich, but now there's like another zero. So I'm gonna get off the couch and go do my stuff and get rich again, and the economy would recover. And so people being at work and you know, having that will to get rich was so important that government could just make it up. You could hire people to stuff money in jars and go out to some blank field and bury the jars in the field, and then just tell people, hey, you know, field X over there has a bunch of jars with thousands of dollars in it. Have at it. And they would all go dig up holes with jars of money in them. And then you could, you know, print up some more money and hire people to go tomorrow and plant new jars, and work would be happening. And since an economy is about working and getting paid, and people would be getting paid and working,
yes,
economic paradise would ensue and everything would be good forever.
So it sounds like we're living in that time right now.
Yes. Yeah. So like I said, his ideas were absolutely dominant. It was extremely popular with politicians, that everything would become good forever if only they could print any amount of money they felt like and give it to anybody they wanted for anything they felt like, and everything would always be good.
So that
are you familiar with modern monetary theory?
No, can I ask you a question first?
Yeah, sure.
So was that why they went off the gold standard in 71?
Yes. So the United States of America, so the agreement was that the US would run a gold standard. Everyone else would peg to the dollar. Other countries could redeem US dollars for gold, but regular people could not. You know, people who weren't governments couldn't have gold. America would have gold, but other governments could get some gold if they wanted to have some gold for some, you know, reason, whatever that might be. But America would keep all the gold since we won the world and had conquered everything. And everybody else would just use a currency based off the American dollar, and everything would be copacetic. Well, in the 60s, America did, you know, we invaded Vietnam, we had massive civil rights and government programs with Medicare, Medicaid, the whole Great Society thing. The moon launch was not cheap. And so, along with some other less salubrious spendings of money, things like the Bay of Pigs and our repeated and comical attempts to murder Fidel Castro. And so the American government was spending, by what were at that point historical standards, absurd amounts of money. Now, by modern standards, it was less than pocket lint, but in historical terms, it was insane. And basically, the French said, "Hey, yeah, that's totally awesome," and obviously, Fort Knox, woohoo! But we thought we would, get the gold. What if, we've got these dollars lying around, and they're just gathering dust, and they'd be prettier, I guess, if we had some gold. And it's not like the French were in a great place at the time. The French government post World War II had numerous major internal, regions and so on. And so, when times are fraught, having some cash, makes you feel better. And so that's what was going on. The French were like, yeah, what if we got the gold? And we didn't have it. Like, basically what had happened during the 60s is that in order to keep the tax rate from going totally bananas, because it was already in fact totally bananas, we had very quietly started printing money, effectively counterfeiting the world's reserve currency. And that had happened, before Nixon had got in, but it certainly didn't stop, on the day that he put his hand on the Bible. But once the French were like, "Oh yeah, that's cool, just give us the gold, everything's copacetic," he had a choice. He basically could have balled up the last of America's reserves, or just said, "Oh yeah, we're bankrupt, there isn't any money anymore." Or he could do what he did, which is say, "You know what if we just didn't do that anymore?" Obviously we could, totally, like, we're still the world's number one, but we're just not going to, because we could, but we don't have to. And so that's what we did. And gold went from, I think it was $35 an ounce or something like that, within a couple of years, to like 900 and something dollars an ounce. And a few diplomatic and other moves and things that I don't even know, I do not have a thorough knowledge of everything that happened above and below board. But it kind of fell back down, right. And it fell back down to something like 10 times its old price.
Well, that's fair.
Yeah. And since then, in nominal dollar terms, it's gone up by a factor of 4 or 5 or something.
Okay. So with all that printing of money, how is that related to inflation? And let me ask this. This is how I believe I understand it. The dollar that you have gets diluted based on how much they're printing. And is that why the price of things goes up?
So the first part of that is exactly correct. The second part of that is where things get squidgy.
Okay.
So inflation is simply the printing of dollars. That's all it means. Inflation can occur even on a hard commodity standard.
Okay.
In fact, when I was talking about the Spanish dragging the silver out of, South and Central America, that's exactly what happened. The the amount of silver circulating, silver was the sort of primary circulating currency of Northern Europe at the time.
Right.
And the Spanish, I believe, roughly quintupled the amount of silver in circulation in something like a decade. And as a result of that, rampant inflation gripped all of Europe because there was suddenly way more silver than anybody could really conceivably imagine. If the world was operating on a gold standard today, that would be a relatively difficult thing to occur at our present technological base, because we know where most of the gold is on Earth. We know how hard it is to get to. Gold would be worth a lot more if it was actually money and not just what we're currently using it for.
Right.
But the gold that's hard to get to is a lot more than 10 times harder to get to than the gold that we're getting to. So it's not likely that we'd get a huge influx, but it's not totally impossible. And certainly in the sort of next phase, we know about an asteroid, for example, which appears to be made out of a hunk of platinum, which
you're reading my mind. I was thinking about that.
Yeah. And that hunk of platinum at modern platinum exchanges would be worth something like $100 trillion, which of course is insane, because
of course,
what would actually happen if somehow you were to get that refined platinum on Earth is, yes, the value of platinum would
go way down.
It's like, oh, that ring's made out of copper. That's so much better than platinum, you know. Have like platinum wiring and stuff. But you know, the inflation is simply the expansion of the money supply.
Okay.
Now, how does that make prices change? That gets very complicated, because prices change through a combination of marketplace factors, that's, you know, that crowds coming up and wanting to buy and being able to buy for more, and non-marketplace factors. You know, the head of you know, Pet Toy Co. decides that his vacation with his mistress in the Bahamas would be better if doggy chew toys cost $50 instead of $45, and so they do now. So the markets are the sort of the undeniable driver. As more common money enters into the market system, then it will be easier to buy for more money. And so those prices will go up, and those raised prices will go into the inputs of things like, you know, Chew Toys Limited, and eventually sort of force them to move things around. You and I are both too young to have experienced this, but when the Hershey Company was going from like an obscure Southern Pennsylvania candy maker to the world dominant brand it presently is, their kind of signature thing was the nickel bar. It was a nickel bar of chocolate. Okay. And the modern sort of fun-sized Hershey bar is roughly the size that the nickel bar of chocolate, like the standard Hershey bar like thing, is about what the original nickel bar of chocolate was. Wow. And the standard fun-sized bar is what the final nickel bar of chocolate got down to before they were forced to more or less abandon the nickel bar. And old man Hershey, like he really, you know, every child should be able to you know, spend a nickel and have a chocolate bar, but you print enough money and that just can't happen anymore.
There you go. Poor children.
Yes, yes. Won't somebody think of them?
Exactly.
But that's a slow and gradual process, and it didn't have to be. Like, he could have just, the first day cocoa butter went up by a penny, he could have just been like, well, screw it. It's the 6 cent bar now.
Yeah. Yeah.
So the price movement is a very complicated thing, and a lot of economists have made huge careers out of figuring that stuff out.
Yeah.
But the sort of environmental wave effect of expanding the money supply, is what sort of eventually drives out all of these other factors. Critically, and this is the part I think is really underrepresented in media and popular understanding, is that because of the way our system works and how inflation flows into it, the first things that get inflated in our economies are asset prices. And people incorrectly like asset price inflation.
Okay. Why? Well, actually, let's define what, I mean, I know what an asset is, but in that context, what are assets?
So assets are objects of value. So land is an asset, artwork would be an asset, shares of companies. These would be the most prominent assets that get affected by inflation first.
Okay.
And so people look at the stock market going up and say, good, stock market went up. I've got a 401k, it's invested in the stock market, it went up, I am happy. Good, home value went up. I own a home, value up, I am happy. A Degas just sold for like $10 million that used to be worth $1 million. Mm-hmm. That makes somebody happy. The general belief is that the reason, this thing is now a $10 million Degas instead of $1 million Degas is that humanity has raised its aesthetic value so much that we now appreciate, it was always a $10 million Degas. We just know now, and we're better people for it. Or my home isn't worth $100,000, but worth $500,000, not because of the rampant and irresponsible stealing of the future from all of humanity, but just because I'm a fantastic person and I made a great investment in land that's really, really valuable, and people have managed to figure that out. And very similar stories are told to people about company investing.
Yeah.
Some of that can be true.
Uh-huh.
And that's the entire basis, like Microsoft really did become the primary business software vendor for a generation.
Yeah.
And that really is an insane money printing operation.
Well, of course.
And so getting in on that in the 80s is really a huge ROI. On the other hand, an insane amount of inflation has occurred since the 80s, and that also raised Microsoft prices. How much of the raise is each factor? We don't know the answer to that question.
Yeah.
And so people just decide that all of that is the good part and none of it's inflation. And so what this does is it causes a sort of damming up of inflation. So as inflation sort of starts, it's jacking up the prices of these things that people own, that people want as investment properties or other things. And people just get this sort of contact high of, oh, look, I'm a genius. All these things I do are really great. The entire world is recognizing that I'm a genius.
Yeah.
What's actually going on is that there's a certain amount of fraud, and that amount of fraud is more than zero, and might be more than 100%.
Right.
It might be the case that all or more than all, you're living on something and you're actually driving it into the ground and it's worth less than it was when you bought it. But inflation is so great that it's going up at the same time that you're actually degrading it.
Mm-hmm.
And there's companies like that.
Oh, absolutely. Yeah, there's all kinds of them. So
where deferred maintenance has been, actually, undermining the asset value of the actual company.
Well, and I want to, that is really, there's been so many stocks that have been overvalued for so long. And, what has been your view on these companies that are making no money, but they keep getting funding and their stock values there? I mean, is that sustainable?
Obviously not.
Well, there you go, I guess. I know, but how did nobody not? I mean, you have to add value to the world. I guess
no, you absolutely do not have to add value to the world. There's no rules. God's not sitting there with a poker like add value, surf, like that's not what's happening.
Fair enough.
Some societies can choose to structure themselves in such a way that value addition is honored more. And some societies like that have existed. I can't think of any off the top of my head that presently exist, but it's a thing you could read about in history. It's not common, certainly. Mm-hmm. Societies generally prefer valuing social and political capital. And those things are trivially worthless because human beings are mortal. And so the people who like those people and the people themselves, die, and then their opinions don't matter anymore.
So what you're saying is it's all just a popularity contest?
Well, no. Actual physical reality really exists. And
I don't know.
Notwithstanding that Bell's inequality just won the Nobel Prize. But coming to grips with whatever the real conditions are and making those conditions better, say 300 or 400 years ago, it would be relatively easy to argue that couldn't really go anywhere because it sort of hadn't for over 1,000 years. But we're a few centuries into the Industrial Revolution. Human beings are unimaginably wealthier today than they were 100 or 200 or 300 years ago. And the global population is 8-ish billion right now. I was alive when it was half that.
Mm-hmm. Crazy, right?
And a century ago, it was about 1 billion, and it had been about 1 billion for several centuries at that point. So there's a vast increase in real wealth. It's just that we've also had a vast increase in real inflation. And so because the monetary value of a thing can't distinguish those two things, for any given asset, some of the gain is from inflation and some of the gain is from actual real value. And like I said, unfortunately, the real value number has more play. It might be negative. So the things that might be more valuable today than they were 50 years ago that are actually worse than they were 50 years ago, but because of inflation, the price is still going up. And inflation, while the input side is sort of very mathematically precise, if there's $1 trillion in circulation and I print $100 billion, then that's 10%. Its effect on things isn't everything goes up 10%. Its effect on things is sort of whatever madness of routing and interconnection happens. So, this thing over here might not change price at all, and then this thing over here might quintuple in price. And that was the effect of inflation. And it would take a lot of effort to figure out which is which.
Yeah. So supply and demand would affect those things, right? I mean,
yes.
Yeah.
Well, and that gets us to where people start turning on inflation and saying, oh, inflation is bad. Well, it's always been, but you were happy about it when it was jacking up your asset prices. Once inflation leaves the sort of asset ghetto and gets into the commodity stream, that's when people tend to really start complaining bitterly about inflation, because that's when it shows up in your cost of living. Mm-hmm. And that's what we're seeing now. And it's not just that. The global transport disruptions of the COVID lockdowns and the blocking of the Suez Canal and Russian sanctions and all these other things are also contributing to a raise in prices, but some probably relatively large amount is that we aren't just dumping all the inflated dollars in Wall Street to let the bankers play with ever faker monopoly money. It's gotten loose, and now it's starting to pour into gas prices and bread prices and all that stuff that people are like, well, my paycheck hasn't gone up by 30% in the last couple of weeks. Mm-hmm. What's up with this stuff? Mm-hmm. And of course, that's where the rubber meets the road.
Well, that's what so many people are upset about today, is that my cost of living is doubled or tripled, but my income hasn't. Right? That's the Main Street argument.
During the severe hyperinflations like Zimbabwe or Weimar or other things like that, people will actually be paid multiple times a day. In the closing stages of the Weimar hyperinflation, there was a morning and evening pay period, because you got a cost of living adjustment between them, because the money you were paid in the morning, the amount of inflation that was built in meant that evening prices would make that money effectively valueless. Wow. And so you had to get a intraday cost of living adjustment and a early day and late day payments in order to keep up with market prices.
What a nightmare for the administrative person to have to keep track of all that. That's crazy. Stagflation. You wanted to talk about it, and I want to ask.
So stagflation was sort of the death knell for Keynesianism, and that's why modern Keynesiasts will refer to themselves as neo-Keynesiasts or something else. Yeah. But at the core, Keynes was like, unemployment's bad, which seems reasonable, and that if you control the money supply, you never have to tolerate unemployment, which is just trivially true, because if I can print up money whenever I feel like it, I can print up money to have people do anything I feel like. Mm-hmm. Mm-hmm. People that are willing to work for money anyway. So he said that the entire world actually worked like that unemployment and inflation had this sort of teeter-totter, situation. And so if inflation was too high, then that was because unemployment was too low, and you could basically push down inflation and get unemployment back up to a healthy level. Or
How would
if
those connect? I'm not sure.
Well, so remember when I said that when it gets into commodity prices, that's where the rubber meets the road?
Right.
Well, where people really, really get upset about inflation, I'm talking about people who matter, people who run governments and financial situations, is when inflation gets all the way into paychecks, because then they have to start spending money.
Okay.
If the price of apples at the market changes, the guy that owns $1 million Degas that's now worth $10 million, that don't change anything for him.
Right.
But if the apple pickers aren't willing to work for a nickel an hour anymore and they want $50 an hour, well, he's employing a lot of apple pickers. And so that's going to cut into his profit margins.
Sure.
And so that's where things like the labor movements and political unrest, when people can't pay for food, they get really upset. And if you push it all the way to the end, then you don't have a society anymore. So
do you think we're on our way there now?
It's an option.
Yeah, it is an option. It is.
But
you can't riot or peaceful protest anywhere. Sorry, I had to throw that in.
Sorry,
no. You can riot depending on what you're rioting about, but you can't peaceful protest depending on what you're rioting or peacefully protest.
Well, yeah, that's a whole different.
Anyway, I'm sorry.
Yeah. So at some point, people will start upping the cost of labor, and that's usually historically when people start talking about inflation crises. And so the idea was that there would be a natural level of unemployment, that there's a labor market, which I can get into all the problems with that, but let's just go with what Keynes is talking about for right now. So there's a labor market, there's an unemployment rate. If that unemployment rate is some natural level, then prices will remain relatively stable, because when an employer goes out to the employment marketplace and there's all the people who are unemployed that want jobs, there's enough of them that the deal he can find is basically the deal that he's offering, and everything's copacetic. If unemployment goes down, then the idea is that the unemployed are going to have, the people who are employed are going to be the people who are the easiest to work with. And so as unemployment goes down, the marginal person that you hire will be less and less agreeable to, less and less desirable to be employed. And so the deal that you can get from or to those people will be worse and worse. And so as that deal gets worse, people will now be aware that people are getting hired for more money, demand higher wages, and so on. And so then you get this, and then that's inflation. So what Keynes turns inflation on its head. He says inflation is caused by wages going up, because once wages go up, then cost of production goes up, and that increases the commodity prices, and then that trickles out into asset increase.
Okay.
But that's nonsensical, because inflation, as he himself admits, is the process of printing money. So it can't be caused by its effect. But Keynes does a lot of this flipping cause and effect stuff because his arguments are nonsense. So because of this nature, he says that there's a connection between unemployment rates and inflation, that the one will sort of go with the other. And so a government, through having a central bank and controlling its interest rates, can choose its rate of inflation. And by doing that, control its employment rate. So the idea is that if your country's operating and you like your unemployment level, everything's copacetic. If social unrest or whatever is causing unemployment to increase, you lower your interest rates, get a little bit more inflation, and everything balances out. If somehow your unemployment rate decreases, you raise your interest rates a little bit, you shut down some inflation and bring everything back to whatever copacetic is. And so that's the Keynesian, that's really the core of the Keynesian model.
I see.
So then in the 70s, unemployment and inflation simultaneously spike.
Okay. And we're still using it today.
And the Keynesians say, what?
Wait a minute now.
That's physically impossible. Those two things are related mathematically like this. Let's try more inflation.
Great answer. Yeah. Okay. Yeah.
And so that's where the monetarists sort of got their innings. And the monetarists said, well, we've been trying inflation for a couple of generations, and we're trying it now. And, unemployment went up for the entire Carter administration. So what if we tried like not doing that? What if we actually raised interest rates? And so then the 80s happened, basically.
Yeah. So what happened in the 80s?
So what happened in the 80s, again, an enormous number of things.
For sure.
But basically, Volcker crushed inflation back down to numbers that people had historically found to be tolerable by jacking up interest rates on T-bills up to the high teens, low 20s, somewhere around there. And all the other interest rates also went up. So if from our old example of the recently escaped convict to the father of four that you've known for 50 years range, the US government was vastly more trustworthy than the father of four dude. So in theory, sort of as much more trustworthy as he is than the recently escaped convict. So if we're charging them 20%, what are we going to charge you, pillar of the community? Credit card interest rates were sky high, mortgage interest rates were sky high, and that's the environment where Icahn and some of those other guys were operating, where they effectively created the junk bond marketplace for ready credit, and sort of created a new way to inflate within the financial system without having to operate at the Fed level, because the Fed had sort of gotten out of the, why don't we just print free money and give it to our buddies, and and meanwhile, thanks to the decades of giving a bunch of free money to a bunch of idiots who happen to work in the financial sector and the government, there were a lot of companies that were feather bedded all to hell and had millions and millions of dollars in assets and hundreds of dollars of value that Icahn and his fellow raiders / activists could go clean up. It's like, oh my God, does anybody here know how to run a company? No, they didn't, but they had free money anyway, so they were. So yeah, that was going on but because rates were that high, one of the things that the federal budgeting does is it says it operates off of a baseline. So if there's a program that's got $1 million in it, and inflation rates are 20%, then next year's program is going to say, well, 20% for inflation, 10% because programs got to grow, 1.3 million baseline.
Right.
And then if it goes into committee and they hack it up and they're like, let's do 1.25 million, that would be a cut. That program, which is spending 25% more than it did last year, got cut from its baseline. The Reagan administration, one of their primary things was a defense buildup. They were like, we haven't, Vietnam happened, everybody got really depressed. We haven't been investing in our armed services the way we ought to be as the world superpower. Mm-hmm. So we're gonna, cry havoc and let loose the funding of the Pentagon. So they got massive budget increases for Pentagon spending, and the guy that he had running the Pentagon slid into the baseline the inflation rates from the early part of the Reagan administration. Something that you might notice in news stories is that every time we hit a new inflation record, it goes back 40 years to 1982. Well, that's because inflation was basically going from the Nixon administration through Volcker finally putting his foot down. Inflation was just going up. And so kind of mid Reagan's first term was the highest inflation rate that America has ever experienced outside of the Civil War.
Right.
Or, there's a couple other crazy events. But there's sort of a wall there of super high inflation rates that are hard to get through before we get to some really crazy stories from like a century or more back. So anyhow, the Defense Department basically wrote those inflation numbers into its baseline projections. And so while a lot of government spending started growing not at 20% a year, but at like 10 or 5% a year as inflation sort of got under control, the Defense Department spending, which was scheduled to increase by a lot and increase massively over time, got to keep the 20% numbers in the mix. And so it went sort of hyper exponential and went way, way, way up. I saw a thing way back then where he was the only person in history to have overspent a blank check. I think some congressman described him. And so that created a big shift in domestic spending priorities. There was also a big shift in the financial system itself. Right. Volcker shut down the way that finance had made money, but innovation eventually came up with some very new ways to make money. Okay. And so that was happening at the same time.
Right. So what kind of ways were those?
Well, you mentioned them actually. ICANN and some of his contemporaries
right. Yeah.
sort of figured out that you didn't only have to play the bond game in the secure bond zone. There was an entire realm of unsecured credit that was still pretty good because people could do a pretty good job. Mm-hmm. Mm-hmm. And like a lot of these ideas, in small doses, it's probably a good idea and probably fine. But in classic 80s fashion and classic finance fashion, we didn't when an idea is good at small scale, what we do is we crank it up to 14 and make it global and make it the only way anyone ever does anything. And in many cases, things become bad ideas when you treat them like that.
Absolutely. Well, that Steven Schwartzman said that, like there's no intellectual property on the ideas. It's just, and that's, obviously true. They just exploit everything.
Yeah.
Whatever works and makes the money that year or next decade.
Right. So yeah, once you demonstrate that loaning unsecured money at 8% to somebody that's going to buy a company can make a bunch of money, why shouldn't everybody loan anybody money at 8% to buy any company?
Yeah. Yeah.
And so they did.
So what kind of innovations are happening today? And with technology and without?
The technology is, I'd say, the primary innovation vector.
Right.
A lot of the other stuff is kind of dusting off what's old.
Right.
So everybody sort of knows that CDOs are bad words, but I'm not going to remember what these things are called. But there's like a collateralized bond obligation, and it's not a debt, it's a bond, which of course those are identical terms, but it's a CBO, not a CDO, and I that's not the connection, but there is, I think it's liability. They're using liability instead of debt.
Right.
But and they reordered the acronym, so it's like
EOB or something.
Yeah, LCO or something like that. But that's mostly what happens. The technology too is mostly taking things that relatively unimportant people were doing and trying to figure out how to get a computer to do it for them. So something like a Robinhood creating a direct brokerage. Right. A broker, a century ago would have been a person that you had to call up on the phone. That person's got a family, they need to eat, you got to pay them. But we replaced that person with a web app on your phone, and then Robinhood's innovation is possibly one of the most viciously evil things I've ever seen. It's front running. So we'll do the business you give us, but not right away, like a broker does. We'll sell the fact that this is the business you want to do to interested parties, and then get paid, and then put your order in. So you don't get to see like whatever the natural world marketplace is. You get to see the marketplace where, it's a boo house and everybody's gotten into their costumes before you walk in the door. And so, but that's okay for reasons.
I don't know.
And yeah, so this gets more into sort of my thing of, my innovation in marketplaces, which I don't necessarily want to talk about in an introductory piece, but this gets into how the market structure depends on the sort of strategic features of that Italian coffee shop. The people who are there have to be going there because they're interested in going there. They have to have an underlying need, and they have to be representing their own actual interests. Because if those things are false, it's not a magic trick. It doesn't work because fairies are like pulling on invisible wires and making it work. It works because those things coming together in that way causes these good outcomes to occur. And so just like any other machine, garbage in, garbage out.
Yeah.
If we shove garbage into the machine, which is what a lot of the modern innovation is basically about, what we'll get back out of the machine is falsehood.
Yeah. So how do you create that transparency today through an online platform?
Well, so for this, I have to go into my thing.
I know.
Thanks for the setup. You have to change the individual's relationships to the marketplace, because the existing relationships are fully corrupted by the ability to do online access. And the differential speeds involved, the differential information involved, sort of the human brokerage, wide network communication of telegraph was basically tolerable, because engines and electricity were making everybody a lot richer, and because human beings are only smart as we actually are, and so there was only so much skim and crap that could be pulled by the middlemen under those circumstances. But we've got computers now, and that capacity allows the middlemen to sort of put up a much deeper obfuscatory screen of what reality is, to their benefit and to the general detriment of the user base. And that's what we've been seeing for the last generation or so, is a increase in the size of the financial system relative to the economy, because computers offer greater advantages to financial chicanery than they do to the utilizers of the financial system.
Right. Okay, cool. So when it comes to history, what else do we need to know?
Well, there's a big old gap basically between the Renaissance and like last Tuesday, or even 1971.
Okay.
So the next big innovation, and we touched on this when the Spanish started sucking silver out of the New World.
Right.
Spain owned the Low Countries, as they were called at the time, sort of Belgium, that Amsterdam was the major port city. Amsterdam was Spain's primary deep water port. The Spanish coast isn't actually all that great to launch ships out of. So the treasure fleets were coming back and landing in Northern Europe. And that's why places like Antwerp and Amsterdam have all that cool architecture from the 1600s and the 1500s, because they had 4 times the entire planet's money supply run through their hands before it got anywhere else. Mm-hmm. And so they decided to build some nice houses.
Can't blame them.
So as a result of that, the markets effectively were replicated. The market technology that had been developed in Northern Italy, they replicated that technology. And because more money was actually there, because money was literally washing up on shore every day, traders gravitated to them. And so this gets into the question of why particular markets exist rather than sort of generalized markets exist.
Okay.
Markets for any given product, have a winner take all quality to them, because in a choice between market A and market B, people would like a market which will give them prices that they prefer.
Oh, okay. Yeah.
And so the more people that are in a market, the tighter it behaves, the more reactive it behaves, and the more accurate it is, which means that the more people that are in the market, the more people want to join that marketplace.
Okay.
And so if you've got two markets, market A and market B, pretty quickly people will distinguish, market A, they're on point, they're doing a better job. People will start going to market A. Market A will become dominant. Market A will become the benchmark. Market B might not go bankrupt. It might stay in operation. But if it does so, it will do so with sort of the understanding that when they think what market A thinks, it's because they're right. And when they think not what market A thinks, it's because they're wrong.
Okay.
And people go where the money is. So when the money started washing up in Northern Europe, that's where people headed.
Right.
And that's where a few different things. One of the first great market bubbles are manias, the tulip bulb mania.
Yeah, I've heard. Yes.
Yes. Which was totally insane, but not any more insane than the dot-com bubble.
No, or any other.
But that's also pretty much where equity markets really got rolling in a major way. The Dutch decided that you could divide up companies into individual stocks and then trade those just like any other commodity. They formalized futures contracts a bit more and turned those into commodity instruments as well. And they got real rich, trading pieces of paper around for a long time.
Yeah.
They didn't get to keep global market preeminence for a couple of reasons. Number one, they rebelled against their Spanish overlords. And as a result of that, the Spanish treasure ships stopped showing up on a regular basis. And since their claim to prominence was free money showing up from, nowhere, when they lost the magic, they lost the magic.
Yeah. Oops.
Also, the physical security of Belgium and the Netherlands isn't terrific in European historical terms.
Okay.
The French, the Germans, and others can and have invaded and done a lot of damage. And so putting all your money in an easily invadable below sea level basket isn't the kind of thing that gives people warm fuzzies. And the British decided to give fractional reserve banking another try, which meant that they could just print free money and didn't have to actually go to the formality of dragging it out of caves in South America.
Well, there you go. And where did that end up with the fractional reserve banking?
We're still in it. The city of London is, in fact, the global capital of the world's economy and has been since then. We in America have a handful of benchmark markets, mostly due to some very fortunate geography. So the primary agricultural benchmarks are located in the United States because half of the world's arable land is located inside the United States. So when you make half the food and everybody else makes the other half of the food, what you say prices are is what prices are, and what other people think prices are is temporary madness until they come to their senses. Also, we did again, when World War II, leading to our companies being some of the most important ones on the planet, meaning that our stock market, which was trading in those companies, was the most important one on the planet, and so on. But to this day, the City of London is the sort of baseline transaction clearinghouse, and their laws and rules set the tone for law and rule in the financial space, from Kuala Lumpur to Boise.
Yeah. So do you dare speculate, like Ray Dalio, about the future of the world superpower, of the fall, which I don't know. The word on the street is that the United States is on the fall, and there's another country on the rise. What do you think?
So that gets me well off topic, and another one of my favorite hobby horses is I think computers are a really big deal, and so I don't think that existing arrangements have a lot of play left in them.
Brilliant. Yeah.
So this is actually relevant to what I was just talking about.
Sure. Yeah.
The English didn't invent fractional reserve banking. It was something they were just giving a try. Up until that point, fractional reserve banking was pretty much universally regarded as fraud. And people in places that had tried fractional reserve banking ended quite badly. In fact, the phrase rack and ruin referred to the fact that in medieval Italy, the torture device, the rack, a thing that you strap a man into and then place weights or turn wheels to literally rip him apart, was actually reserved for people engaging in fraudulent finance through printing money. So basically, fractional reserve bankers were the only people that were to be publicly tortured to death as the penalty, because having counterfeiters run your economy turns out very badly for everybody.
Maybe they need to reconsider.
Yes. Fortunately for the banks of the City of London, they came up with their Dodge at more or less exactly the same time that the steam engine was busy being invented by James Watt, and humanity's relationship to economics changed from a very slow linear process to a very fast exponential process, which is what the ride that we've all been on for the last quarter millennia or so. So the problem with fractional reserve banking is that if you exponentially expand the money supply and the economy doesn't exponentially expand, then people rapidly realize that you're counterfeiting their money, because prices start going up, and the kinds of prices that people care about start going up. And that leads to the usual political unrest. And if that political unrest gets laid at your head, then what happens. And peasant rebellions, dying to the rack is nice compared to what peasant rebellions historically do to people. So the only way to make it work is to have an exponentially expanding economy. Well, steam engines, suddenly you could get real useful work out of rocks that you pull out of the ground, and you could actually build machines to make pulling those rocks out of the ground easier. And anytime what you're doing changes the speed at which you can do what you're doing, you get into an exponential relationship. And so pumps, jackhammers, trains created an exponential progress spiral for coal mining, and allowed fractional reserve banking to not immediately devolve into the general death by horrific murder of everyone who was in charge of anything in Great Britain. Yeah. Bad things did happen from time to time in that time span. There were a couple of world wars, for example. But
yeah.
But that's pretty much where we are right now. And the economics profession has largely decided that it was the banking innovation that caused all that cool stuff to happen, and not the engineering innovation that allowed the banking innovation to not cause what had happened every time people had tried that in the past, which people tried in the past a lot. We know what it looks like to not have Watt steam engines when you do this, and it's civilizationally collapsing.
Mm-hmm.
So I think computers have offered us the very powerful potential for a vastly greater economic expansion, in some ways that are sort of trivially obvious to describe, although not very many of them are actually pursued. And so we have a lot of capacity, but if we use that capacity in ways that sort of make what's currently broken worse, then things will break down. If we use that capacity to sort of fix up what's currently broken, or make what could work so much better it doesn't matter that these broken things are around, then we'll be okay.
Mm-hmm. 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 Absolutely, man. Well, look, I gotta wrap up, but I mean, there's another couple hours we could do on all of that. I mean, just all the little things that could be innovated. I wanted to end, because I love economics, and I find it hard to find a nonpartisan, unbiased book on the subject. Do you know of any, in the economic world? I mean, I've read some Thomas Sowell, and that's, pretty good, but
well, so 18th century writing is different from modern writing, but Adam Smith's stuff is relevant today and is
okay,
quite readable. I mean, he goes on digressions on stuff, and he's really obsessed with the wool market, but you can get past some of that stuff, and his ideas are, like I said, they're still fresh. Also, I can't really remember the titles off the top of my head, but I read a couple of graduate textbooks on market microstructure theory, and frankly, there aren't very many of them. So
that could be
you can you can just look up graduate textbooks on market microstructure theory, and there's like 5 of them. The 2 I read were both excellent, so I don't know if they're the best 2 or if they start sucking, but they'll get into some of these things. The trick is that political bias is an intrinsic part of all of these things, because economics is still effectively a political science, and they've sort of decided not to acknowledge that about themselves. And a lot of branches of economics act like currency is like, handed down by nature or something, or this or that is a physical law of the universe. But the potential exists today to turn economics into an actual physical science, because in the 20th century, we managed to figure out the connection between information, energy, and entropy, which allows ideas and communication to be a physicalizable system and analyzed using the methods of algorithmic analysis and thermodynamics. Mathematicians, the economics has upgraded its mathematical chops in the last century. It hasn't upgraded them that much. The amount of mathematics and physics economists would have to study and master to be able to do that wildly exceeds the current intellectual effort, which is not inconsiderable, that any of them have ever exhibited in all of history. So a physical economics is something that could occur as a general thing. I myself have made a contribution to algorithmic economics, which I hope to be of great practical use. But the thinking is extremely medieval and is also very tightly political, because governments are the leading actors. Economies require law first, because why give the blacksmith a chicken for a nail if I could just kill him and take the nail?
Yeah.
If there's no law and there's no morality,
yeah,
why not just take everything that everyone you see has and then, walk up to the border and take what they have as well, and just keep doing that until you get coshed in the head one day? And the answer is that, fortunately, you'll get coshed in the head fairly quickly if you were to do that.
Yeah.
But systems of law and systems of law that enable high functioning economies are another open problem that we're still struggling with. And there are little shards of goodness in movements like socialism that recognize some of the issues with some of these things. The people who basically tell you, oh, we've got it wrapped, if we just do the thing that works, then things will work, are high on their own supply, basically. Because the one thing we are absolutely certain of is that we don't know how it works, and nobody else ever has either.
No, that's for sure. It reminds me of, there was somebody in history that said, "Oh, I think everything's been invented to this point." It's like, what are you talking about? That's crazy. I don't know.
There's nothing new under the sun. That was a Greek philosopher whose name escapes me, and it was over 2,000 years ago.
Yeah, there you go. Right. So silliness. All right, man. Well, thank you again so much. I appreciate you as always. It's always fun to do these things.
Yeah. And like you said, we could do part 2 someday.
Man. Well, yeah, sooner than later, I'm sure.
And get into some of the nitty gritty, because this was sort of the high level skipping over the top of things.
Yeah. Well, let me know. Like, I'd love to dive into market microstructures, and send me an email, on some of the things that we can get into the weeds about. That'd be great.
Okay.
All right. Cool, man. Thank you. We'll talk to you later. All right.
Okay. Bye-bye.